What exactly is a credit crunch, and why does it seem like so many people are so concerned about it? Federal Reserve officials are saying it's unclear whether SVB will cause a credit crunch. Bloomberg reporting that it's the last thing that the strained economy needs. The Street is talking about how this will affect earnings and stocks are set to move lower. And Bank of America is talking about how we are to see another liquidity crunch because of these bank crises. Fox News mentioning how this could really impact small businesses. And advice being sent to small business owners about securing loans right now before they are no longer available. So why in the world would a credit crunch be such a big deal for the overall economy? Well, the answer has to do with number one, supply chains, and number two, the fact that business doesn't run like household finances do. If you've been through any personal money management courses, seminars, read any books, watched videos about how to manage your own personal finance, here's basically how it goes. Number one, you get your paycheck. You know what your paycheck is going to be in advance because you know what your hourly wages are, you know what your salary is, so you know what you're going to get paid. This month, next month, and the month after that, you know the exact amount that's going to be coming into your account. So basically what you do is you say, okay, if $10,000 is coming in this month, I know $1,000 is going towards insurance, $2,000 is going towards mortgage or rent, $500 is going towards groceries, $3,000 is going towards savings, $4,000 is going towards taxes, and I have no idea if I'm already over 10,000 or not, but you get the point. The money comes in, you already have a plan for what you're going to do with the money, and then you go do those things with that money. The money comes into your account and then you go spend it. This means that if a credit crunch were to hit you personally, basically what that would mean is maybe you can't use your credit card anymore in order to make those purchases. When you go to the grocery store, you can't run your credit card because maybe they don't have interest-free loans even if you pay off your entire balance. Maybe just using the credit card, they'll charge you interest that's more than the points that you're getting. Maybe they reduce your credit line that is available to you. And so maybe you can't use your credit card anymore. Doesn't make that much of a difference for you though, because the money comes into your account and then you spend it. And so for the average American who knows how to handle their money, a credit crunch means basically zero. But that's not how business works, especially in the United States. Do y'all remember how during 2020 and 2021, there was a little problem with this thing called supply chains? Because through globalization and the over financialization of our economy, we've gotten to a point where everything runs on something called just in time. Basically, I need to get these raw materials so that I can produce this product, and I'm going to send that product out to somebody else, and they're going to take that product and use that to make the end product that finally goes to sit in inventory at a retailer, and then somebody, an actual individual, buys it. So there's 4 to 1 million steps to actually get something into the hands of a consumer, and all along the way, transportation of all of that has to take place. And so if you have one break in that chain, the whole thing doesn't function. For instance, we had issues with parts for semi-trucks being able to get delivered to the mechanics for the semi-trucks. Well, guess what vehicles used to deliver those parts for semi-trucks to mechanics? Semi-trucks. And so semi-trucks started breaking down, but they couldn't be fixed because there weren't enough semi-trucks to deliver the parts to fix the semi-trucks so that the semi-trucks could deliver the parts. You see what I mean by these are all complex and intertwined, and that's just one problem. This was happening everywhere with everything. Nobody could get the parts that they needed to send on to the next person, which meant the next person couldn't get their parts to send on to the next. So why am I going on about supply chains? Well, basically it's because supply chains, as Zoltan Pozsar says, are just payment chains in reverse. So there's a whole supply chain out there that exists for the payments, for the money that exists in circulation for the entire economy. And if a link in the payment chain breaks, then just like a link in the supply chain breaking, the whole thing grinds to a halt. Now, if businesses operated the same way as individuals who knew how to manage their money, this wouldn't really be a problem, because a credit crunch, meaning you might not be able to access debt, would just mean, okay, well, when the the cash comes in, I'm going to spend the cash just like I always do. But most businesses don't operate this way. Not only are businesses more over leveraged than they've ever been before, but as we all know, interest rates are rising. And so as interest rates are rising, businesses have to look at this and say, okay, are we going to just continue to devote more of our income to paying the interest on this debt, rolling it over, taking on new debt to pay off the old debt, and then now we have to pay more of our revenue to just maintain the debt? Or are we going to take more of our revenue right now, pay down the debt so that we can have more cash flow in the future? And so because of the over leverage and now the rising interest rates, this is causing businesses to have to scale back on their spending. And every one person's expense is another person's income. So this means less income to go around. But this is just the minor problem, just the first one. The second problem right now is deposits. And really, this doesn't have much to do with the small people, the individuals who have less than 250,000, although there is still a deposit flight of that taking place to the big banks. But FDIC covers up to 250,000. Most businesses have a lot more than that in working capital. So they're not going to stick around at the small banks. They're going to move their assets and distribute it among the bigger banks that they know are too big to fail. And no, too big to fail does not mean that the bank is too big to fail. It means too big to be allowed to fail. So people know that if I have my money with Chase or Bank of America or Wells Fargo and they go under, we know the government will save them. But the government didn't save any of the non-insured depositors from any of the bank collapses that happened in 2011, 12, 13, 14, 15, 16, 17, 18, and 19, which there were bank failures every single one of those years. And as those deposits, the large deposits, start to leave those banks, that means debt becomes unavailable to anybody else while that bank still exists. They have to tighten their lending standards because deposits are going out the door. They can only make loans given how many deposits they have. And if deposits start to leave, they cannot continue to lend. And this is where the big problem specifically for businesses comes in. The way that payments are made among small, medium, and especially large businesses is with something called net 30 terms and net 90 terms. If I'm a very, very small business, a small individual, or just like an actual individual, when I buy something, I have to pay for it in order to get it, right? Well, the bigger you are, the less that is true. I can buy something from you and I don't have to pay you until 30 days later. And if I'm really big, I don't have to pay you for that until 90 days later. And so if you want to do business with the big boys, you have to be okay accepting net 90 terms. What's the problem with that? I have to create a product and I have to deliver it, and then I have to wait and continue to do business for 3 months before I ever get paid back and make my profit on that original sale. And no, that does not mean that I have a ton of cash reserves and I'm doing this out of my cash flow. It means I'm using debt. I've got a credit line. I'm using credit, and the bank knows in 90 days I'll get paid by Walmart for this. And so the bank is okay funding that for the next 90 days. And this is where credit crunch gets dangerous. Because of the deposit outflows, because of the bank runs, and because of the liquidity crunch, this credit crunch, banks are tightening up and they may be removing a lot of this available credit for a lot of these businesses, which means they can't do business anymore. Most businesses that are small and medium-sized businesses that are operating under net 30, net 90 payment terms and just waiting for this money to come in, they're doing this by credit. And if those credit lines dry up, that debt is no longer available to them. They can't make payroll for the next 2 months waiting for that cash to come in. They don't have a stockpile of cash sitting there that they can start to use instead. So that's the reason why the Federal Reserve, that's the reason why Bank of America and Fox Business and so many analysts are worried about a credit crunch, because it could literally bring the economy to a grinding halt. Businesses live and die. They survive on those credit lines. And if suddenly they're no longer available, we simply do not know how many businesses will fold because they can't make payroll for the next 3 months until they do get paid. And if you would like to take your financial education to the next level and be able to learn how to profit off of big drops in the stock market or just a lack of volatility, or you'd like to learn how to allocate your portfolio so that you don't have to worry about these ups and downs in the market, I've got the solution for you. It's a membership to Heresy Financial University, where you get access to my training, courses, programs, guides, linked in the description below. As always, really appreciate you guys. Thanks so much for watching. Have a great day.